For the FOMC, we expect a steady continuation of the tapering program. So very likely they announce another 10 billion cut. And also we're not going to hear too much from them because this time there is no press conference scheduled. However, interestingly, there is also economic data, GDP data coming out, and for more export and inventory reasons, so not something too fundamental, but in any case, it could be a bit on the softer side than comparing with consensus this time. So if these two things coincide, and we think there's still a chance that Chairman Yellen may feel obliged to speak. She has a speech scheduled the next day at 8:30, the Independent Bankers Association. So maybe she'll still be compelled to give a bit of a statement as to what's happening. Yes, we see the US on a very firm footing. So the self-sustained recovery and also the sort of austerity effect from recent years from the government spending starting to fade away. So we expect an acceleration in US GDP growth both this year and also to a smaller degree perhaps next year. But nonetheless, that would be befitting for the Fed then to take the first steps, we think, close to the middle of next year, and by the end of 2015, we expect the Fed fund target rates to be around 1.25 already. At this point, it is not a big threat to the global economy. And we have basically stacked it a bit into risk scenarios. So certainly a riskier scenario already, and we attach quite a bit of likelihood to it, is that the sanctions could become a bit stronger, and really on both sides. So not just sanctions against Russia, but Russia also retaliating. But I think the real tail risk, we only assign a very small probability to that, but if it happened, would certainly have an impact on the global economy. Would be if we see Iran-style kind of sanctions against Russia, so targeting perhaps the energy sector, targeting the financial system, or really cutting off access to other regions entirely. And then if that gets compounded with some retaliation tit for tat from Russia, only that would really have the potential to negatively influence the global economy. But as I said, we see it as a rather remote scenario at this point. On emerging market sides globally, you could maybe categorize them in two groups. So one is the reform beneficiaries. So there we have Mexico. Mexico is reformed and also should benefit on an ongoing basis from the proximity to the buoyant US economy. We also have that case for China, where we think, yes, there is some short-term pain probably for China, but the long-term gains certainly outweigh that. And the second category in EM that we like is the exporters, so those countries, or especially the equity markets, that benefit very closely from the US and also the Europe recovery that's going on. So specifically, this would be Taiwan and also South Korea. They tend to have very strong correlation to when the economies in those two regions improve.